Yeah, hello guys. So the topic for today's video is why does China buy and hold a lot of, huge amounts of US dollars? Like, did you ever know that China buys a lot of US dollars and they hold them for a long period of time? Yes, this is the article that we are going to go through. It says in August 2022, Asian nation owned like $971 billion in treasury, roughly 30% of US national debt. Right? What China does is for the things that it exports to US, it gets the US dollars, right? So that dollar, what it does is like it will hoard it and it will buy treasury bonds for those the dollar US dollars that comes into China, right? Why do they do this is what we are going to discuss in this video, right? So yeah, so to sum it up, this is the graph of US treasuries owned by China, right? See, around 2000 it was like $73 billion, and right now in 2023 it is close to 1 trillion US dollars, right? 1 trillion, yeah, a trillion US dollar. As of Jan 2021, China owns like 1.095 trillion dollars of total 28 trillion dollar US national debt. So yeah, it's primarily, China is primarily a manufacturing hub and an export driven economy, right? For any export driven economy to make big money, their currency should have a low valuation, right? If for example, let's say if one US dollar is like 20 Indian rupees, right? What happens is like whenever someone buys outside India, so they, for every US dollar they'll get 20 rupees value inside India. But think about this thing: if one US dollar is like around 100 rupees, they'll be getting more. They can get more stuff, more products for within India with a single dollar when it is 80 rupees, right? So that's the economics here. So yeah, see, this says China has been running a big trade surplus with US since 1985. This means that China sells more goods and services to US than US sells to China, right? So see, Chinese exporter receives USD for their goods they sold to US, but they need yuan to pay their workers and store money locally. So what they do is like they sell these dollars to the Chinese central bank and get the RMB or yuan, right? Which again increases the US dollar supply and raises the demand for RMB, right? So yeah, this is the gist of it, but there are a lot of moving parts in this discussion. Chinese central bank, what they do is like, unlike other countries, they actively intervene and adjust these rates, right? For example, if you take India, Indian government does not actively, though it might passively intervene, but not actively intervene to change the conversion rates or dollar to US dollar to INR rate. They don't actively intervene unless it is extremely important, something like that. But Chinese bank, Chinese central bank, they actively intervene and prevent these imbalance, like how they do in their production, their manufacturing, all those things, like local prices, even those are like actively intervened and adjusted. Inflation is adjusted, local prices are adjusted, everything, right? So what they do is like they buy these available excess US dollars from the exporter and give them required yuan, right? So what they essentially can do is like they can print as much yuan as needed, and effectively this intervention by Chinese bank creates a scarcity for US dollars, right? For example, if they are printing $100 million, let's say they set an exchange rate for every $100 million you'll get 20 million USD, right? If they are like printing more of yuan, so what happens naturally is like when you used to get 20 million US dollar for 100 million yuan, now due to excessive printing you'll get the same 20 million dollar with 150 million dollars of yuan, right? So what happens is the scarcity increases for US dollars, right? You'll have to give more yuan to get the same amount of US dollar, and that means the demand for US dollar has increased, right? When the demand increases, it will keep the US dollar rates higher compared to Chinese yuan rate, right? Chinese yuan's rate. So what happens is like this devalues Chinese yuan rate, or it devalues the yuan, which again makes their exports competitive, right? If in global markets, if there are more USD compared to yuan, what happens is like value of yuan increases, and thereby the competitiveness in their export reduces. But if it is the other way around, wherein the value of USD is higher compared to yuan, what happens is like you can get, for example, if with $1 you can take 100 yuan, let's say you get 100 Chinese yuan, that times people would be more interested in a country which gives them 100 yuan conversion rate compared to another country wherein you can only get 50 yuan for the same US dollar, right? So it will improve or increase their export competitiveness, right? Also, this again pins to the point where the China is naturally a manufacturing hub and an export driven economy. So it is essential for them to keep their currency prices low, so that their export competitiveness is like managed, right? Yeah, there is another concept called self-correcting currency flow, wherein when a country tries to manipulate its currency, what happens is it starts to self-correct. For example, it's like they've given an example where Australia is running a current account deficit. That is, Australia is importing more than it's exporting, right? Other countries which are sending goods to Australia are getting paid in AUD. So there is a huge supply of AUD in the international market, thereby leading the AUD to depreciate in value against other currencies, right? Okay. However, this decline in AUD will make Australian exports cheaper and imports costlier, right? So Australia will start exporting more and importing less due to the lower valued currency, right? So this will ultimately reverse the initial scenario. So this is that self-correcting mechanism, right? So what is the China's need for a weak renminbi, right? So since it is an export-led economy, it needs to keep their currency low in order to offer cheaper prices in the international market. So what is the need for China to keep its currency weak, right? Since China is basically an export-driven economy, only having lower currency rates will help in being more competitive in the global market. And if that cannot happen if the RMB or yuan appreciates in its value, right? See, yes, this is what is given in this line, right? Thus it keeps the RMB value low compared to USD, using the mechanism that has been described above, right? So however, this leads to a huge pileup of USD, right? What happens is like whenever these exporters get paid in USD, they go to central bank, or central bank asks them to give USD and get RMB so that they can pay their employees, right? So what happens is like there is an artificial scarcity of USD. right? Since nobody has USD, there is a scarcity of USD in China, which leads to an appreciation of USD value. When USD value appreciates, people would be willing to pay more RMB, right, to get the same USD. When people are willing to pay more, the value of RMB artificially decreases or naturally decreases. This is the strategy that they want, so that the competitiveness is like maintained, right? Yeah, I'll be adding all these links. You guys can check it out. There are a couple more links as well. This is another good video. Let me play
In order
this.
to maintain a trade imbalance, we know that the Chinese central government needs to keep its currency artificially weak. And to do that, they essentially can print their currency and use that to buy US dollars. So what they do is they increase the supply of yuan and they increase the demand for dollars, keeping their currency weak. Now, the next question you might ask is, what do they do with the actual dollars that they bought with the yuan that they printed? Well, they don't want to just sit on those dollars. They don't want to, they prefer to be collecting some type of interest on that money. So instead of just keeping it all in some warehouse someplace, they actually just lend that money to the US government. And they lend that money by buying US Treasury bonds, by buying
Right. So this is the whole concept, right? Okay, that's all for this video. Thank you.